Mona, let's start with this equity market. You like quality growth. What is quality growth?
Yeah. Hi, John. Thanks so much. Look, I think we started this year looking at a market that was driven by better than expected economic data. We saw a strong January jobs report. We saw better than expected retail sales. And we certainly saw inflation, at least towards the back half of last year, starting to move lower. But I think the trade into what we'd call more cyclical parts of the market probably happened too fast, too soon, earlier on this year. So to your question, as we get through this year, we need to see a couple of things before we can kind of revisit that recovery playbook or that cyclical playbook. We would still need to see, one, of course, inflation move meaningfully lower. Two, we'd like to see the Fed actually step to the sidelines at some point, probably middle of this year. And then three, we are starting to see earnings being revised meaningfully lower at this point for 2023. We haven't seen that bottom yet. So until those conditions are in place, we'd say probably the market is going to take a more defensive tilt. We could see continued volatility. But at some point, when those conditions are met, maybe towards the back half of this year, we do think that investors should think about diversifying into those more recovery parts of the market. That includes quality growth. That means growth that is not negative earnings yielding, probably not as speculative parts of the market. And then, of course, areas like cyclicals, even parts of small caps, international could be interesting as well. So all part of a recovery playbook that could happen down the road.